I think we're just at the start of a whole new phase for the international monetary system in which these physical assets, and especially the critical metals and the precious metals, can move much, much higher. If you look at the latest research, some Wall Street banks are openly talking about triple-digit silver. I think the Bank of America has said that at the end of this cycle, silver will be trading between 150 or $300 per ounce. And well, this used to be crazy stuff. We as gold bucks were writing down, but now it's getting mainstream. And these are such small markets. So I think it will surprise everybody how high this can go. I told her we'll see at least a double from here. So let's say silver $200, gold 10,000. But I might be too conservative.
We are entering a new era for the global financial system where physical assets reign supreme. Wall Street is finally catching up to long-standing bullish predictions, with major institutions now openly forecasting explosive gains for precious metals amid critical shortages. Willem Middelkoop, founder of the Commodity Discovery Fund, asserts that we are just at the start of a massive repricing event for critical and precious metals. He notes that major players like Bank of America are now projecting silver to trade between $150 and $300 per ounce by the cycle's end, targets once dismissed as crazy by mainstream analysts. Middelkoop argues that because these markets are so small relative to global capital, the inevitable rush into physical assets will drive prices to shocking heights. Consequently, current record highs may actually be conservative entry points, predicting at least a doubling from current levels, with targets of $200 for silver and $10,000 for gold. The analysis suggests the bull market has ample room to run. As these targets become mainstream consensus, the ceiling for prices remains virtually unlimited. Now, we present the clips from Willem Middelkoop's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think this is the fourth year in a row that central banks buy over 1,000 tons of physical gold every year. And if you know, worldwide gold production is just 3,500 tons. So if central banks are fleeing towards physical gold, what message do you send to the general public and to high net worth investors? So you have this trend now worldwide that high net worth investors and retail investors want to own physical gold and silver. Look at the images coming from China and Hong Kong. There are long lines for these bullion shops. And this is very significant because the US used to control the prices of gold and silver. They could do that because they had this very liquid future markets, the COMEX market. But the price discovery mechanism has moved away from the West to the East now. So the US no longer is able to control the prices of gold and silver. They follow the Shanghai Gold Exchange now. And this is a massive topic. Literally in my book, I wrote The Big Reset, The War on Gold and the Financial Endgame, to show that the US has been managing or manipulating gold and silver prices and other commodity prices at least since the 1970s. And they're losing control now. And that now we're entering a very interesting but very dangerous era, especially for the US. And that also explains why Trump administration is doing crazy stuff like Venezuela now. They need to do something, otherwise they lose it. We just crossed that line. So they used to own 7 times as much in value US treasuries compared to physical gold. But they've been adding, like I said, for 4 years in a row now, massive amounts of physical gold and quite going parabolic. And now with the increase of the value of that gold, the amount of physical gold central banks hold worldwide is now a larger amount than their US treasuries, all their US treasuries. 25 was the start of a revaluation process in which the price discovery mechanism has moved from west to east. And this means that the revaluation process won't stop after a few quarters or a few years. If you look at the amount of paper assets, the 100 trillion in bonds, if you have these changes in the flow of funds, like the Wall Street guys advising now to put 20% of your net worth in gold, this trend could have legs. It could go on for years and even decades. And I think we're just at the start of a whole new phase for the international monetary system, in which these physical assets, and especially the critical metals and the precious metals, can move much, much higher. If you look at the latest research, some Wall Street banks are openly talking about triple-digit silver. I think the Bank of America has said that at the end of this cycle, silver will be trading between 150 or $300 per ounce. And well, this used to be crazy stuff. We as gold bugs were writing down, but now it's getting mainstream, and these are such small markets. So I think it will surprise everybody how high this can go. I always had 5,000 gold for starters, but well, we reached that one. I always had $100 for silver. Well, we almost reached that. I was called by a girlfriend, a former girlfriend. I almost married her 40 years ago. I'm an old guy. And I advised her to buy gold in the 1980s. And she found me that the value of her gold and silver holdings was up crazy. And she was very happy. But it told me that, we're still so early in this game. Who were in gold and silver in the 80s and 90s? Nobody. And now everybody's starting to react, and everybody wants to jump the train. But everybody's waiting for the correction. And this is very interesting. Everybody's waiting for the correction. And the correction is not coming. So gold and silver will come down one day and decline 10-20%. But I think the corrections will be pretty short-lived. And what's my next target? Because that was your question. I told her we'll see at least a double from here. So let's say silver $200, gold 10,000. But I might be too conservative.
For the fourth consecutive year, central banks have purchased over 1,000 tons of physical gold, accounting for nearly a third of global production. This relentless accumulation signals a historic shift. The West has lost its ability to manipulate prices via the COMEX, with true price discovery migrating to the Shanghai Gold Exchange. As lines form outside bullion shops in China and Hong Kong, the message is clear. The smart money is fleeing U.S. treasuries for tangible assets. Market analysts warn that this transition creates a dangerous vulnerability for the U.S. dollar, as central bank gold holdings now exceed the value of its treasury reserves. We are in the early stages of a monetary reevaluation, in which Wall Street banks, once bearish, are now forecasting silver at $150 to $300. While retail investors sit on the sidelines waiting for a correction that never comes, the bull market is leaving them behind. Targets of $200 silver and $10,000 gold are no longer fantasy. They are potentially conservative estimates in a world where the U.S. can no longer suppress prices. Let's get back to the interview.
When people talk about inflation, I always point to them that they should look at the broad money supply and the debasement of currency. So inflation is just, let's say, the outcome of all this money printing. But I think people understand, more and more people are starting to understand this. So more and more people are starting to invest in all the government can't print. They go to hard assets, gold, silver, Bitcoin, real estate being the best of the hard assets. But everything is on fire now. In our portfolio, 50% of our positions is precious metals related. The other 50% is critical metals, so copper, uranium. Nickel is starting to move. Copper is breaking out. Lithium is turning the corner. Even platinum, palladium do well. I think zinc will follow. So the whole spectrum is on fire. So we were up last year 70% gross return. In the first trading days of this year, we're up 8%. So we've been waiting for this for a long time. We started in 2008. That was the top of the last cycle. We had an awful bear market. We were always quite successful to take in new money. We had net inflow every year, and that's why we're very fortunate to have this pool of capital now at the start of a new bull market. And this bull market will have legs. It won't be a few quarters like in 2016 or 2020. This will take years and probably decades to play out. I'm quite convinced about that. I coined the term superinflation. I don't like hyperinflation because hyperinflation is very rare. You get that in Venezuela and Zimbabwe and the Weimar Germany, that was 100 years ago. It's quite hard to get into hyperinflation. And central bankers will do everything, including going back to some kind of gold standard to avoid that. But you can have superinflation. What's superinflation? That's, well, let's say inflation of over 10%. And we had that around 21 and 22. And that's very harmful just for the general public. And when you've had 2 years of superinflation and then the inflation comes down to only 3 or 4%, it's still on top of the double-digit inflation of previous years. So people every day they're doing their shopping. They notice that it will be harder and harder to buy the groceries with the budget they have. And so I focus on actually, we focus on the money growth. If you look at bankers, central bankers, if you look at the financial system, if you look at politicians, they all need to grow the system. And growing the system means growing the money supply. And there's 400,000 billion of assets looking for a safe haven for returns. And look at how small the precious metals area is. Silver is just 4 trillion, the whole silver market. And all these markets are so small, even uranium. So you need little institutional money to move to these pockets of the industry. And then you see these very strong moves upward because the mining space and the natural resource space has been depressed for such a long time. And still the valuations, we just did the study in-house, the silver miners, the producers, are still valued as low as 24 before silver broke out. Why? Because the silver price has been rising faster than their share price has risen. So the ounces in the ground are still, you still buy them at rock bottom valuations. Well, they all went up over 100% last year, so everybody thinks they're expensive now. But look at their price-earnings ratio. I think that's an honest method of valuation. Barrick and Newmont are 10, 11, 12 on forward earnings. Look at Apple. The tech guys, the tech investors always say Apple is cheap because the PE, price earnings ratio, is 25. Well, if you call that cheap, how cheap is 10 to 12? And what does Apple own? Of course, you have a great network effect, but they don't even own the factories. And look at what the Newmonts and Barricks own. They own all the ounces in the ground, which still need to be revalued. So there's so much more. There's so much upside based on the current valuations. Another metric we use, we look at what's the valuations of the ounces in the ground. We are specialized to invest in the junior space. So the explorers who make the discovery, the developers. So they have a negative cash flow. It's very hard to value it, but you can look at the valuation of the ounces they discovered in the ground. We still buy gold ounces in the ground valued at $30, $40, $50 per ounce. Of course, takes a lot of time and energy and money to get it out of the ground, but this is a rock bottom valuation. It's just 1% of the gross metal value. And we buy silver, which is still in the ground, valued at well, pennies to the dollar, 10, 20 cents for an ounce of silver. So we expect a real strong and long revaluations of the ounces in the ground. And another example is the producers, the gold and silver producers. They were up over 100% last year, 140% on average. The exploration companies who are finding the new ounces in the ground, they were up only 40% last year on average. So there's so much more of a revaluation to be expected, and this tells us we're in a very early phase of this whole recovery process where you have this new bull market. I have my own portfolio. I've been using that for the last 20 years. And that's what I do, not for the fund, but for my own net worth and the family. 25% in real estate. It's money outside the financial system. You just put it in bricks. It's there. Then 25% in physical gold and silver, money outside the system. Minimize the number of doors between yourself and your net worth. And then 25% in equities. That's the most risky part, maybe. But you can do well when stocks go up. And then 25% we keep very liquid. I always said cash, but I changed that to Bitcoin. So let's do Bitcoin because it's fast horse in the race. It's virtual gold. You can also keep that outside the financial system. So when the financial system has a big accident, banks might close, stock exchanges might close. You always have the best part and the largest part of your net worth will be outside the system, and you still be able to do well in every scenario.
We are entering a dangerous era of superinflation, defined as inflation persistently exceeding 10%, where central banks are forced to expand the money supply to keep the financial system afloat. This massive liquidity injection is driving a historic rotation of global capital, with over $400 trillion in assets seeking safety in a surprisingly small commodity sector. The entire silver market, for example, is valued at just $4 trillion, meaning even a tiny fraction of institutional inflow will trigger explosive price appreciation as capital flees debasing currencies for hard assets. Market veterans argue that despite recent gains, the mining sector remains fundamentally undervalued, with gold and silver producers trading at just 10 to 12 times forward earnings, pennies on the dollar compared to the tech sector. To navigate this reset, experts advocate a survival portfolio allocated equally across 4 pillars: 25% real estate, 25% physical gold and silver, 25% equities, and 25% Bitcoin. This strategy ensures the majority of wealth remains outside the banking system, protected from counterparty risk and systemic accidents, while positioning for the commodity supercycle. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.